Hi everyone, welcome back to Finance 3000. This is chapter 7. We're going to talk about stocks. First of all, how are stocks and bonds different? By now we know how to price bonds, and we know a lot about what is going on in the bond market. Basically, it plays with the interest rate. Okay? But how's stock different? Why do we hear more news about the stock market rather than the bond market? For any asset, we know the valuation involves figuring out what will be the future cash flows from this asset and what is the appropriate discount rate. And we have a rough understanding of the discount rate, which should reflect the opportunity cost of capital from the investor, namely the return an investor require from this investment. In other words, the best return the investor has given up in order to put money into this asset. Okay? It has everything to do with risk. And then on the cash flow, the numerator. The bonds have everything fixed. You know exactly what coupon you're going to receive and what is the face value at maturity. Even if you don't hold it until maturity, the sell price on the market at a particular point of time is determined by the interest rate, by the appropriate discount rate. And the discount rate reflects the base level of interest rate in the economy, the inflation rate, and the risk level of this bond as compared to the safest bond, which is the treasury bill. But for stocks, both the denominator and the numerator can change. The discount rate reflects the risk level which can change, which contains both the basic risk level of the economy, the Fed funds rate, plus inflation, and plus the individual stock risk from the company. And the riskiness of the stock is not the same as the riskiness of the debt, because remember that debt get paid first. That's why debt is less risky than stocks, okay, because of seniority of payment. But in the numerator, the cash flow, as investors, we don't know exactly what kind of cash flow we can receive. The company is not obligated to pay dividends, and they are free to change the amount and the frequency they pay in terms of dividends. The resale price of your stock cannot be reasonably expected at the point of your investment. And everybody disagrees so much on the resale price. That's why there's such a big trading volume in terms of stocks. Okay? Basically, for bonds, only the denominator is moving. But for stocks, both the denominator and the numerator can be quite uncertain. We have 2 weeks for chapter 7. In the first week, part 1, I'm going to familiarize you with the basics of the stock market, typically in the US. And we're going to talk about the concepts and terminologies we frequently refer to in the stock market. And then we're going to go into the 3 most often used methods of stock valuation. And then in the next week, we're going to focus on discussions about the stock market and how efficient the market is, namely how fast information reflected in prices and whether there's arbitrage opportunities to make profit. And then we're going to connect to behavior finance, which is how emotion and human biases come into the market. And we'll try to connect to the hot topics we have been discussing so far, GameStop and SPAC and everything that is getting a lot of attention from the stock. Recall in chapter 1, we talk about the financing decision a financial manager should make. The financing decision happens in a market, a financial market, which we call the primary market. The primary market is where funds from investors flow into the corporation in need of funding. They can have help from the financial intermediary, but the final destination will be the corporation. For example, when a company goes to tap the public equity market for the first time, they go through an IPO, initial public offering. That's the first time they raised equity capital. After that, they can come back to the primary market to raise additional capital. But as long as the capital is flowing from the investors to the corporation, we're talking about the primary market. There's also 2 types of stocks. Most oftentimes, when we refer to equity or stock or stockholder, we talk about common stock. Common stock give you both the claim to future cash flow associated with the stock and voting rights in corporate decisions. So common stock represent the true ownership in any public held corporations. The other type of stock is called preferred stock. Preferred stock give you shares which has claim to the future dividends, the future cash flows, but there's typically no voting rights with preferred stock. Well, why it is called preferred? Because they get paid first in terms of equity. They get paid before common stock. In case of bankruptcy or financial distress, the company have to pay off anything they left to the debt holder first. Okay, and that always have priority or seniority than equity. But among equity, when you have any dividend to pay, the company have to pay the preferred stock owners first for dividends. And if they're paying any additional dividends, they go to the common stock. Right? That's how common stock and preferred stocks are different. But not all companies have preferred stocks. There's also a case where common stock have multiple classes, like Class A common stock and Class B common stock. They represent different voting rights. For example, Class A can have 2 voting rights for 1 share, and Class B only have 1. That's also the cases for a number of companies, but not all of them. Once equity is issued into the financial market, any trading between the investors, among the investors themselves, the buy and sell orders, they happen in the secondary market. You can think of it as the second-hand market. When you first buy something from the store, and then after you get it, you can feel free to sell it in the second-hand market to another buyer. Okay, who can in turn sell it again. It's all called the secondary market. The secondary market for stock can happen on the exchanges. In the US, the 2 largest exchanges are the NYSE and NASDAQ. NASDAQ doesn't have a physical location. It is just basically an electronic network, like most secondary markets these days. And the NYSE have a really nice big board in front of it, and it's not far from us. Well, the secondary market basically gathers the buyers and the sellers about a particular stock. There can be financial intermediary making a market about a stock, basically facilitating the transactions among the investors. The key difference between a secondary market and a primary market is that any transactions between the stockholders has nothing to do with the company who issued the stock in the first place. Right? If I buy 1 share of Apple Computer stocks from the market today, Apple gets nothing. They only get funding when they first issue the stock. And there are 2 types of orders I can place if I'm interested in buying or selling a stock in the secondary market. If I just want to buy or sell as fast as possible, I place a market order, which the trader will just cross the market order with the best offer in the market at this time. But if I have a price point which I want to reach before I can buy or sell, I can give a limit order. When we talk about bonds, we talk about 2 types of prices in the market, the bid price and the ask price. In the stock market, a bid price is the highest price at which investors are willing to buy shares. Okay? Investors can submit a bid for the same stock at the various prices, but the highest price is reflected on the secondary market as the bid price. Someone who is willing to sell if you place a market order to sell immediately, your order is going to be crossed with the best, highest offer price to buy, the bid price. On the other hand, the ask price is the lowest price at which current investors are willing to sell their shares. So if I want to buy a share right now, my purchase order is going to be crossed by the ask price, the lowest, the best offer that the trader can find for me. For all public companies, their trading information and a lot of their financial information are public knowledge. If we are interested in one public company, there are 3 types of sources we should go through to have the complete picture. The first resource can be just Googling it. We can enter the name of the company or simply the ticker of the company if you know it, which will be their listing name on the financial exchange. Here we typed FDX for FedEx, and the current price of FedEx immediately showed up, and how much it has changed from the previous day. Day-to-day changes, it changes all the time, up and down, and how it has changed over different frame of time. You can change the specific here. And now you know a summary of their trading information. How much they opened, what is the highest so far in this day, what is the lowest over the day. Market cap, which is the size of the company, price per share multiplied by the outstanding share numbers, PE ratio, which we're going to define later, price divided by earnings per share, dividend yield, dividend divided by price right now, previous day's closing price, the highest price over the 52-week period, and the lowest one. Okay, and you can also have some basic information about the company. This is one way to get information about a public corporation. The other way is just to go to their investors relation site in their company's official website. FedEx. Okay. Almost all large public companies have a website devoted for investor relations, where they summarizes all the important information that investors should know about the company overviews, and news and events, financial information, etc., etc. And if you want more complete information about the company's financial statements, you should go to the SEC EDGAR website, which we mentioned before. This is where all public companies are required to file their financial statements. For those of you accounting majors, you're very familiar with this site already. It just summarises basically everything you can find about the firm is on SEC EDGAR, and it goes back to all the years since the first year the company became a public company. We talk about 10K, which is the annual report, 10Q, which is a quarterly report, SG&A, anything about management, 8K, any events that going to be reported to the investors. Basically, public companies need to keep their investors in the same loop by providing timely information so that investors who are owners of the firm know what's going on. Okay, as also the communication between the owners of the firm and the agency of the firm, who are the managers. A few terminologies. We know dividend as the periodic cash distribution from the firm to the shareholders. When the firm have net income, they have to decide whether to retain them for reinvestment or distribute it in terms of dividend. The dividend yield is dividend per share per dollar of price at the market right now. It measures how much return you can get in terms of income while holding the stock. It's comparable to the current yield from bonds. PE ratio is a ratio of stock price to earnings per share, EPS. There are two types of PE ratio. One, if you see something called a trading PE ratio, that means the earnings per share we used in the denominator was from last year. And the forward PE ratio, on the other hand, uses the earnings forecast for the next year. The PE ratio gives us an idea of the market evaluation of the firm. Per dollar of earnings, which is an accounting number, how much is the market willing to pay for the firm's share? If they are willing to pay more than dollar to the earnings of the firm, it must be because the market believes in the firm's prospect. Okay, that's also why we use the PE ratio as an important pricing multiples, which give us a lot of idea about the market evaluation of the firm, as we're going to discuss later. Suppose an investor wishes to purchase 100 shares of FedEx with a bid price of $118.92 and an ask price of $119.07. How much could the investor expect to pay for the shares? Well, he expects to pay for the shares what people already have the shares asked for. So you use 100 shares times the ask price to get the money he's due to pay. What is the forward PE ratio and forward dividend yield? For the PE ratio, we need earnings per share. So we go back to the table where we have earnings per share information. Well, we see that the trailing 12 months earnings per share for FedEx was negative, back to when I searched it, I think it was last year, or it's from the textbooks, it's a few years back, and it's definitely not now. And since we're talking about the forward PE ratio, we're using the 1-year target earning instead of the trailing 12 months earning. We use $142.72, which is what the market expect the earnings will be next year for FedEx. Okay, we have the bid price divided by forward earnings per share, and the PE ratio is $0.83. So it was really a difficult time for FedEx because the market is willing to pay less than $1 for $1 of their earnings per share. FedEx's dividend is expected to be $2.60 per share. Divided by their bid price, we have the dividend yield, 2.19%. Okay, this is how the basic calculations is done. In capital markets, we talk about value a lot, but it's important to distinguish first which value we're talking about. From chapter 3, we already know what's the difference between book value and market value. Book value records anything happening in the past, how much the company has paid for all their assets minus depreciation. And it's backward looking because it does not reflect anything that is going on in the market today. The market value is how much the investors are willing to pay for the company's asset in the market today. It can be very different from book value. And a third value we consider is called a liquidation value. It's different from book value and it's not the same as market value as well. The liquidation value is the net proceeds that could be realized by selling the market's asset, by selling the firm's asset in the market and paying off the creditors. Basically, it's the market value of all of your assets, but it doesn't consider any value of a successful going concern in the sense that the company can make more money in the future. As when the company is declaring bankruptcy, we're trying to sell everything that we have in the market. Okay, so make sure you know the distinguish between the liquidation value and the market value and book value. The liquidation value may be different from book value. Same way as when we have a used car, we're going to sell it in the market. The price we can sell it for could be different than our initial purchase price of the car minus any depreciation we want to add. The market value is different from book value or liquidation value by one key reason, that it treats the firm as a going concern. What is a going concern? A going concern is an entity which is going into the future and it's going to generate value in the future. The market have this value, while liquidation and book value does not. Because when we buyers in the market want to purchase an asset, we're looking into the future, how much future cash flow this asset can bring us. This depends on the assumption that this asset is going to keep operating. If the asset being a firm with the equity of a firm, it will be the future cash generation ability of the firm. Then what are the sources of going concern value? What is the future? What can the future bring us? How? It has a few components. The first one is the earning power from assets. Instead of selling the asset in the market, we know that the machine can keep running and it's going to keep cash coming. So it's going to be the earning power from current assets, existing assets. The second component is any intangible assets not already recognized on the balance sheet. We talk about intangible asset being something that doesn't have a physical shape and is pretty difficult to value. The only intangible asset have a place on the balance sheet is goodwill. The additional capital one company paid when purchasing another company. But there are other intangible assets typically not having a place on the balance sheet, but will be very useful in generating future value for the company. For example, brand name. Okay, brand name is valuable as we all know, but it doesn't have, the balance sheet doesn't have a section where we list the brand name of a company. First of all, it's very difficult to value, and it's very difficult to have an objective pricing for a brand name. But as long as the firm is running, brand name is keep generating additional value, and the market is going to recognize that. Similar to brand name, we have expertise, experience, knowledge, and relationship, etc. And all those things only generate value when the companies keep operating, keep as a going concern. R&D input. Okay, R&D input is typically before, only when the company is still doing research. Their R&D input can eventually be turned into value. Okay, and then the third part is the value of future investment. We know they already have some assets, and this assets is generating value, and they have some intangible assets which also generating value. But for the market, we're also looking into the future. We know that the company can make future investment, and if those future investment can generate return, it's going to further increase the value of the company today. And as a rational investor, we do our pricing, we discount all the future cash flow this asset can bring us to arrive at the market value of the asset. And especially for new industries and growth company, we know that their asset today does not represent all of their future investment capacities. As a business major, I'm sure a lot of you guys is being asked by the family and friends the question that is it a good time to enter the stock market right now? And especially when the market is going down. And people know that when the market is going down, it might be a good opportunity to go into the market if you're not already in the market. On the other hand, nowadays, the question will be on the reverse. Is the market in a bubble, and should we sell? If we were Warren Buffett, we're going to be asked the question a lot more. Now we're going to see how is his investment philosophy. In a video which is between a interviewer and Warren Buffett back in 2007, they were talking about his investment philosophy in one stock back then. Okay, and in the video, I want you to focus on what he says about his way of investing. What is his general principle of invest in any stock, and what he doesn't care? What are the information irrelevant to pricing? Okay, the usual disclaimer applies for any YouTube video we show in the class.
Berkshire, and that was PetroChina stock. A lot of people interested in your purchase and subsequent sale of PetroChina. This is a controversial stock for our viewers who aren't familiar with it, because the parent company, China National Petroleum, had some dealings with the Sudanese government that, of course, the Bush administration has said is responsible in part for the genocide in Darfur. I watched in May at your annual meeting where shareholders came up, some of them very unhappy, and wanted you to divest. You disagreed. You took a shareholder vote. Most shareholders agreed with you. You did not divest. That was May. Now, since September, you've been selling. Have you sold your entire stake of PetroChina?
Yeah, we've sold it, but we sold it based on price. It had nothing to do. I mean, I think at the time of the annual meeting, it was around, in terms of the American stock, it was around 110, and I think it's more than double since then. Unfortunately, I sold a little too soon, but it was 100% a decision based on valuation. When we bought PetroChina, the whole company was selling for $35 billion. If you take the number of shares and multiply by the price, when we sold it, it was at varying prices, but it was at about 8 times that price, about 275. No, I'm sorry. It was more. The original price was 20 in terms of U.S. We sold it from 160 to 200 or something like that.
A nice tidy profit.
Yeah, we made about $3.5 billion on a $500 million investment. As it turned out, I still sold it way too soon. Since I sold it, they must have shot a gun off and said, "Warren sold. Now it's time to let it go up."
Well, yeah, you left money on the table.
A lot of money.
Dummy.
That's exactly right.
Charlie Munger would say.
Charlie would say, "You've done it again."
But you can't keep always trying. For the average person who's maybe never bought a stock before, what's your advice about that? You can't constantly sit there and wait and say, "Oh, it's going to go higher, it's going to go higher."
We don't even think about that. What we think about is how much is it selling for? How much do we think it's worth? When we bought it at $35 billion, effectively, I felt the company was probably worth at least $100 billion.
How did it come to your attention? How do you find a stock like PetroChina?
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company, and told about the oil reserves, told about the refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
And how do you value it?
Well, that's the trick. But it's essentially what I would pay for the whole business if I could buy it. And when we sold the stock, it was valued, we'll say, at probably 250 to 275 billion. And we thought that was a fair price. Now, oil had gone up from $30 a barrel to $75 a barrel. Now it's up even further. But today, yesterday anyway, I believe PetroChina is the second most highly valued company in the world. Higher than GE, next to
ExxonMobil.
Next to Exxon.
Have you sold the entire stake?
Yeah, I have. Mm-hmm. I wish I hadn't, but I have.
As of when?
Well, we sold it over a period of time.
Sold it over a period of time.
If it went down a lot, we'd buy it back.
Would you ever buy or sell a stock based on political pressure or
no.
sort of...
So
people being upset about Darfur had nothing to do with why you sold the stock.
The Chinese government owns 88% of PetroChina. They also own control of 29 out of the 30 largest companies in China. The Chinese government is the one that has a position in relation to the Sudan. And they have it. If you own any one of the 30 largest companies in publicly traded companies in China, you will have the Chinese government as your majority partner. And the question is, are you responsible for their actions?
You're going to China next week for a ribbon-cutting ceremony for ISCAR.
Sort of the limit of my abilities, Liz. That's what they use.
You're pretty good at cutting a ribbon.
I've gotten used to it. Yeah.
Are you looking at other companies in China?
I don't look based. No, the answer is pretty much no. But I don't look based on countries or that sort of thing. I just read every report I can, and I try and figure out whether something is cheap.
But how would you find a report like PetroChina 4 years ago? This was not a name that maybe a lot of people would...
Other guys read Playboy. Yeah. I read annual reports.
Are there any reports?
This is a great centerfold, actually, when I hit PetroChina. And that's what I do. I mean, that's my job, is to allocate capital. And the way I allocate capital is by looking at the opportunities for using capital.
If you're interested in Warren Buffett and his fundamental investment philosophy, which is what is taught in business school these days, is that the mainstream investment philosophy, which I personally also think is the best way to invest. And there's additional videos here. Now let's talk about valuation. The first model we're going to discuss is the dividend discount model, which basically discount the future dividends together with your resale price back to the present and find out the worth of the stock. The cash flow from stock have two parts: all the dividends you receive while owning the stock and your resale price. Okay, and then we discount all the future cash flow by the appropriate discount rate to the appropriate number of times to get the present value. That's the same valuation step for any asset. For example, we buy the stock at year 0. We plan to hold it for 1 year. The company pays 1 dividend during the year. So we can find out what is the worth of the stock by discounting dividend 1 and P1 by 1 plus R, because it's only 1 year's time. We call this V0 the intrinsic value of the share. The intrinsic value of the share is the present value of all the cash payoff from the stock anticipated by the investor who is doing the valuation. We emphasize that this is the intrinsic valuation by the investor is because everyone can have a different judgment on the intrinsic value of a stock. That's why people trade. People disagree, so they trade. If after my forecast of the dividend and the future resale price, I arrive at a V0, which is lower than the market price, well, I think the price is overpriced. The price does not reflect the value. I will not become the buyer, or if I can short sell it. Or if I already have the share, I'll sell it in the market because it's overpriced. On the other hand, if my valuation V0 is higher than the market price today, that means the market price does not reflect what I think that the stock is worth. And it's a good bargain. So I'm running to buy the stock before other people can do that if I think my valuation is really correct. If the dividend we expect is $3, the end of the year price forecast is 81. The discount rate is 12%. Then the intrinsic value of the stock should be $75. And 75 is the fair price for the stock if the dividend is 3 and the end of the year price is 12 and if the discount rate is 12%. I emphasize if is because in valuation, everything we enter into the model is our assumption. We can be having really good assumption, really good forecast, and we can have bad forecast. The model is always correct, but whatever number we get out of the model depends on our inputs into the model. To emphasize the meaning of discount rate, the discount rate is the return we ask to earn if we buy this asset at their intrinsic value, receive all the income, and sell it at the horizon, at the end of our investment horizon. So if our stock is actually trading at $75, which is a fair price for the stock, our expected rate of return will precisely equal to the discount rate we used. To verify this, we can have the definition for expected rate of return, which is expected income plus expected price change, the difference between your purchase price and your resale price, per dollar of your initial investment, which is also your purchase price. Okay, R equals to income plus price change divided by price initially. We get 12%, which equal to the discount rate. If it's actually trading at $75, there's no difference between buying, selling, or not, because the stock is trading at its worth. We only make buy or sell decision when the stock is either undervalued or overvalued. We can separate the expected rate of return into two components. One is dividend yield, and the other is capital gain yield. It's mechanically true because the formula for expected rate of return can just be simply divided into two parts, right? We have the same equation, but what if we separate this two part by two fractions? The first fraction is the first dividend divided by P0, investment, the purchase price. And the second part is the price change divided your purchase price. This is the market price you purchase the stock with. And the first component is called dividend yield. Remember the definition for dividend yield. And the second component is called the capital gain yield. And the combination of the two is the expected return. Doing this gives us a better idea of where is the source of return. Is it coming from a really fat dividend, which is typically from a cash cow, the name we call companies who pay large dividends? Or is it from capital gain or appreciation in the value of the stock, which typically come from growth stock as compared to income stock? Okay, give us more information about the source of the return. if after our valuation we find out a stock priced significantly below the market price, or we find a stock significantly above the market price, the value is much higher than market price, we think we have found a bargain. And this in finance we call arbitrage opportunity. We talked about arbitrage opportunity before, but we didn't formally define it because it's quite an advanced topic in finance. You can understand arbitrage as anything that you can earn return without taking any risk. If we find a misvaluation, we can realize a profit by just purchase or sell decisions without taking any risk if we believe our valuation is correct. But what if a good number of people have the same conclusion? For example, if we find the stock we just valued is trading above $75, and then we know the expected rate of return to be lower than the discount rate, which is easy to check, right, from the same formula. We have found a mispricing. The stock is trading on top of its worth. What should we investor do? If we already have the stock, we should go and sell it because we can realize a profit and we know the price is going to eventually come down to value. Well, but if sufficient number of us already realized it, what will happen? Everyone's going to go sell, and this sell order, this force of the market, is going to drive the price down to $75 if that's the correct price of the stock. And if the market is very efficient in reflecting the information, and if everybody is quick in their action, before we can get to sell the stock, the price has already dropped. Arbitrage opportunity is already gone. On the other hand, if we find the stock to be trading below $75, but it's actually worth $75, according to our valuation, we will rush in to buy it. And we will compete who runs faster to buy it, who click the mouse faster. If the market is efficient, as we're going to define efficient market later, and if inflation is quickly impounded into price, everybody is going to buy it so fast that by the time we realize it's mispricing, this arbitrage opportunity has already been gone. Okay, that's why arbitrage opportunity is very hard to find. And that's also why that we still trade among ourselves, is because not everyone is going to arrive at $75 valuation. Whatever we put in the model, going to decide what's going to be the outcome that we get. But the market only have one price. Why do we disagree so much about the cash flow of a stock? Well, because it's unpredictable, because of uncertainty. If it's for sure, we won't disagree. We won't disagree about how much a coupon bond is going to pay next year. We won't disagree how much it's a par value for the bond because it's already fixed. For the stock, are they going to pay dividend? How much they're going to pay and how much will be their price by the end of the year is all uncertain. That is also why the realized rate of return or the actual rate of return can be different than your expected rate of return. We use our expected rate of return as our required rate of return in the pricing model. But what we get is what's actually realized after time. For example, if over the year the firm paid dividend of $3 as expected, but the price at the year end turned out to be $90, much higher than the level we expected at the start of the year. For example, it could be a tech stock back in 2018. It had an average return of 35%. It surprised everybody. Okay, and then we can calculate the realized return for the investor who purchased the stock at $75 per share initially. The rate of return is realized is going to be the dividend paid plus the actual price change divided by your initial investment. 3 plus 90 minus 75 divided by 75. Suppose we bought the stock at 75 and our return is 24%, much higher than the 12% we have forecasted, which is good, right? But things can happen from the other direction. For example, if we happen to invest it in the energy stock by the start of 2018, our return could be much less than what we had. We realize that stock valuation is all about assumptions about future cash flows, about the inputs for dividend and the price. Well, the dividend is somewhat easier to forecast because companies typically start paying dividend and they announce a dividend paying schedule and they typically want to stick to it, because not sticking to your promised dividend send a very negative signal to the market, which corporation is going to avoid by all costs. This is sometimes called dividend racketing. Once they start paying dividend is pretty easy to forecast. It's pretty predictable. The tricky part is the end of the year price. If we were investing over the year, what's going to be our resale price? If we buy Apple computer today, by the time we want to sell it in a year, what kind of price can we sell it for? Well, how much can we sell it by the end of the first year depends on how much a new investor can get cash flow after they bought the stock from us by the end of the year. If by the end of year 1, we had sold the stock to another 1-year investor with a 1-year horizon, the investor is going to decide how much he or she is willing to purchase the stock from us by seeing what is the present value of the next year's cash flow, which is the second dividend from the company and the end of the second year price. If we're standing at the end of the first year, V0, the value of the stock by the end of the first year, is the discounted value of the end of the second year cash flow, discounted once, because it's 1 year between year 1 and year 2, right? And if we use this V1 as our estimation for the stock price at the end of the year, we use this V1 as our estimation for P1 into the 1-year pricing model. We have P1 equals to V1 equals to DIV2 plus P2 divided 1 plus R. It sounds like a mouthful, but it's a simple replacement of 2 1-year models. Okay, and we already have the first year, V0 equals to this. Then we have V0 replacing this P1 by our new result. We have that if we have a 2-year investment horizon, this is basically our discounted cash flow model all over again. Our valuation of the stock value by the end of the by now equal to the first year's cash flow discounted once and the second year's cash flow discounted twice. Okay, this is a simple mathematical maneuver. If you just multiply 1 plus R to both numerator and the denominator, we get this result. And then the question becomes, what is the end of the year P2 price? What is the stock's price at the end of year 2? We know dividend 1, dividend 2 is pretty predictable. If we stay with the same forecast, we use the same opportunity cost of capital if we think the risk didn't change. And then all we have to do in valuation is to forecast P2. How do we do that? Well, we repeat the same process as we forecasted P1. We can forecast that P2, the price at the end of the second year, equals to the value of the stock by the end of the second year, equals to the cash flow another 1-year investor will receive over year 3, which will be the year 3's dividend plus the resale price at the end of year 3, discounted once. And then we replace this part into the previous pricing model. If we repeat this all the time, we can find out that if we plan to sell a stock by the end of year H, which we call the horizon year, the end of our investment horizon, the value today is equal to all the future cash flows we can receive from the stock all the way to our horizon year. It will be all the dividends we can receive in between and the final resale price, PH. Now we know that V0 is the fair price for an investor who plans to hold the stock for 1 year. But the same V0 is also for another investor who plans to hold the stock for H year. This two doesn't differ. Okay? If you look closely at all those formulas, the valuation formula for investors who plan to hold the stock for different number of years, 1 year, 2 years, 3 years, H year, they all arrive at the same valuation today at year 0. Because although they have a different investment horizon, they are using the same information, which is the schedule of all the future dividends and like all the future dividends they have to pay. How about we forecast PH? PH can be discounted by dividend H plus 1 and PH plus 1. And we can repeat this to all the way in future. Then we end up with a infinity stream of dividends. Just all the future dividends the company is going to pay all the way into the future, into infinity. That's the information we need. And another piece of information is the discount rate. As long as our forecast to all the future dividends and the discount rate stays the same, it doesn't matter when we're going to sell the stock, we're going to have the same valuation of the stock's value at time 0. Okay? And to conclude, the intrinsic value of a stock to an investor is the present value of the dividends it will pay over the investor's horizon plus the present value of the expected stock price at the end of that horizon. Price at the horizon date depends on expected dividend from that date forward. As long as you have the same stream of expectation about future dividends and the same expected rate of return for the stock, which reflects the riskiness of the stock, you're going to have the same valuation, no matter how long your forecast horizon is going to be. Put things into the number. Okay, I think this is an example from the previous version, but on the textbook, it should have a equivalent version from it. And it's basically trying to illustrate the irrelevance of horizon years. And however long is your investment horizon, the valuation is always going to be $75. But the composition is going to be somewhat different. For a 1-year investment horizon, the present value of the terminal price is going to take the majority of that $75, while the present value of dividend is going to take a smaller part. But as we go way into the future, the dividend stream, the sum of all the present value of the dividends we can receive over the life of the stock, over the life of our investment horizon, is going to take the majority. And the final resale price, because it's happening so far into the future, is going to have a lower proportion in the present value. Now, if our investment horizon is infinite, we know corporations have an infinite life theoretically. Because they are corporate, their separate legal person is not bounded by any of the life of their owners. And so theoretically, we can have an investment horizon of infinite. We never plan to sell it. We just buy the stock, buy and hold, receive all the dividends. We can do that. So then we can ignore the final price, especially when it's happening so far off into the future. The present value is going to be minimal. Then our stock price is going to be the present value of all future dividends per share. Basically, this is true for any investment horizon. Your stock price is always equal to the present value of all future dividends per share. When you have a 1-year horizon, you only write out dividend 1, and P1 summarizes all future dividend after year 1. The same logic going to whatever the horizon year might be. Okay, this is a generic pricing model for stock. The same simple logic applies to all asset valuation in this course. The value of an asset equals the present value of all the future cash flow from this asset. It does not depend on your investment horizon, because even if you sell this stock or this asset in the market, the price you can sell it reflects the the present value at that point of time of all the future cash flows you haven't received yet. Well, even if dividend is the only thing that we need to forecast down the future, but it's still a lot of work for all of the dividends, then we start to look for patterns in the dividend paying schedule. If those dividends fall into a cash flow pattern we have learned so far, that can make pricing easier mathematically. Now we analyze 3 cases of the dividend discount model. The first case, dividend discount model with no growth, have the same dividend every year, so valuation reduces to a perpetuity present value question. Case 2, the dividend discount model with constant growth. Then we have a geometric sequence with a constant growth rate. Then it's also simple. Case 3, which is a more realistic case, the DDM with non-constant growth. And we're going to combine all the tools we have from the first 2 cases to do the third case. Case 1, the DDM with no growth. If a company pays a constant dividend every year, which means that dividend T is equal to dividend 1, value of a no growth stock is simply the present value of a perpetuity that we have learned in chapter 5. P0, price today, equals to next year's dividend. I have to emphasize this again. We emphasize this when we talk about perpetuity. For the formula to work, the first cash flow we use is 1 year ahead of the point of valuation. If we're standing at today, and the constant dividend payment starts by the end of this year, or by the start of the next year, dividend 1 is the first cash flow we have. It's 1 year away from today. Okay? If we receive the cash flow today, we will have to make adjustment by adding dividend 0 on top of this formula. DIV1 divided by cost of capital is the present value of the stock with no growth dividends. And we know that dividend is part of earnings per share. Dividend per share is part of earnings per share. The other part goes to retained earnings. But if a firm does not retain any earnings as reinvestment, they pay all of their earnings, all of their income, net income, as dividend. Then EPS by the first year is equal to the dividend of the first year. And then we have P0 equals to EPS 1 divided by R. Put things into number. There is a company which have $25 per share per year in terms of earnings. EPS is $25, and it does not grow. It's a very mature company, has no investment opportunities. It just generates whatever cash from their existing assets. So they pay all of their earnings out to the investors. The investors' cost of capital is 20% per year, because that's their opportunity cost of capital from other ventures. Then how much is the stock price of this company? Assume the company keeps operating indefinitely. Here we have dividend by the end of the first year equal to earnings per share by the end of the first year. $25, cost of capital 20, and we divide the two to get the price of the stock today, $125. Straightforward question. The second case. What if the company is still growing and they pay an increasing level of dividends? Every year, the dividend they pay per share is increased on top of the previous year's dividend by a fixed growth rate. Well, this is a growing perpetuity. And because this is a geometric sequence, some simple mathematical tricks which we're not going to go over here yields this following formula. Okay? With a growth rate, the growing perpetuity, the present value of all the future cash flow equals to the first cash flow by the end of the first period, divided by the difference between the discount rate and the growth rate. And naturally, we can see that the higher the growth rate, the higher the price, because the growth rate G is both in the denominator and have a negative sign in front of it. As long as this growth rate is smaller than the rate of return or the cost of capital, we have this formula established. And we call this the constant growth dividend discount model, or Gordon growth model. And again, to emphasize, the first cash flow is by the end of the first year. And the second cash flow is what is going to start growing. Okay? Only the second cash flow, dividend 2, is growing on top of dividend 1. What is the value of a stock that expects to pay a 74-cent dividend per share next year, and then increase the dividend at a rate of 5% per year indefinitely? Assume a 7.8% expected return. Then we have everything we need. The first dividend, the dividend by the end of the next year, and the difference between the cost of capital and the growth rate. Okay? And then we get the present value to equal to 24.43. Another example, suppose a shift in electricity use allows Ameren UE, which is an electricity company, to generate 3% per year expected future growth without sacrificing immediate dividends. How would the stock price change, given expected dividends next year at $2.1 per share and discount rate at 10%? Right? And this is a good news to the investor because of the growth rate. And we know that the higher the growth rate, the higher the price today. Then we can see that the price jumped up compared to when the growth rate was 0. Simple calculation gave us $30. Note that another caveat is when we are analyzing the impact of the news on stock price, we have to keep in mind that it might have impact on both the cash flows in the numerator and the discount rate in the denominator. Here, we know that it has nothing to impact the dividends for next year. The dividend for next year doesn't change, and the only change is the growth rate. But we also have to be sure that this good news is a one-time thing. At least it does not change the cost of capital, the riskiness of the company's business. If it has anything to do with changing risk, for example, the company switched to another industry, that might have changed R as well, and it will have a different results from pricing. But here, at least in chapter 7, we still keep R as constant. Okay? And in chapter 11 and 12, we're going to see what factors can change the discount rate for the company and how do we estimate the discount rate. Note that in the constant growth dividend discount model, we assume the growth rate G is a constant rate after time 1. All the following dividends is going to grow upon the previous one. This is a really big assumption because we know for most companies, things do not stabilize. The growth does not stay the same from year to year. But what if we are talking about a really mature firm for which the growth has already stabilized? Then our question will be, how do we estimate the growth rate for such a mature company? And for the next few slides, we're going to focus on the topic of how to estimate the constant growth rate or the sustainable growth rate. First of all, what is a growth rate for anything? We measure the rate of growth by the addition to a value per unit of the initial value. For example, the growth rate of population in the United States will be the addition to the population divided by the starting value of the population. Same for anything. We're talking about growth. For shareholders' equity, the growth rate of shareholders' book equity will be the addition to book equity divided by the starting value of book equity. For example, we're talking about the annual growth rate of shareholders' equity for a particular company. We will find out what is the addition to the shareholders' book equity over the year and what is the starting value of book equity from the start of the year. There are two ways to add book equity to the firm's balance sheet. One way is to retain earnings from net income, the organically generated earnings from the firm's operation over the year. And the other way is to raise additional capital. We know that raising additional capital is not a sustainable way of growth, because you cannot assume the company can raise capital forever. It will be at one time when the company cannot raise any additional capital and all of the growth is funded internally, namely from the reinvestment of retained earnings. So we assume that once the firm stabilizes, the sustainable growth rate, the growth rate that can be carried over year on forever, will be the growth rate that is funded by internal reinvestment, namely the addition to retained earnings. So we define sustainable growth rate G as the additions to retained earnings divided by initial book equity. In most cases, we're talking about the annual growth rate. Recall in the income statement, when we reach the bottom line, we have net income. And then we have to worry about the allocation of net income. We can either pay them out as dividends or make addition to retained earnings. This is where we find the addition to retained earnings. And then from the balance sheet, we can find what is the firm's starting level of equity. For example, if we are asking for the growth rate of equity capital, we're talking about book value here, the book equity value from the year 2013 to the year 2014, namely from the entire year of 2014, we use the starting value of equity as the end of year level for 2013. Okay, and we can find shareholders' equity level here. And we know the addition, this is retained earning, and the addition to retained earning over the year 2014 is from the income statement. Now let's look closer to the sustainable growth rate. We already know that how fast a business book equity can grow sustainably depends on how much addition to retained earning they can make. And this addition to retained earning also depends on two things, as we're going to see really fast. One is the profits generated by investment, as measured by return on equity, net income divided by shareholders' book equity. And another factor is the proportion of earnings reinvested into investment. And we call this ratio the plowback ratio, which is 1 minus the payout ratio. If you think about it, on the balance sheet, on the income statement, one portion of net income goes to dividend. And dividend divided by net income is going to be the payout ratio. And the other is the retained earning. Retained earning divided by net income is going to be the plowback ratio. And of course, the plowback ratio and the payout ratio add up to 1. Okay, now we know that what is payout ratio, what is plowback ratio. Basically, they measures what is your distribution of earnings over the year, how much you used to reinvest in the same company, and how much you used to pay out your shareholders. Then we already defined the sustainable growth rate in book equity as the addition to retained earnings as a portion of initial equity. And we can further separate this ratio into two parts. By adding a net income in the denominator and then again on the numerator, we can separate this fraction into two parts. One part is the addition to retained earning divided by net income, which we just mentioned is the definition for plowback ratio. How much proportion of net income have you used to plow back and reinvest in your company? And then another part is net income divided by initial equity, which is a definition for ROE, return on equity. How much profits you have generated per dollar of the contribution from your shareholders. Okay, and then we can find out that the G, sustainable growth rate for book equity, will equal to plot back ratio times ROE, which is equalized to 1 minus payout ratio times ROE. Right? Note that we have made a few assumptions along the way. If we want to use this formula as our sustainable growth rate in the pricing model, in the constant DDN model, the constant growth DDN model, we know that we have assumed the firm will maintain the same payout ratio in all the future years we have in horizon. Okay, we have assumed the constant sustainable growth rate. So we assume that all of those components into the formula is the same payout ratio. The firm always pay out the same proportion of their net income to shareholders. Okay, typo here. A second assumption we make is that the firm maintains fixed capital structure. When their retained equity grows, they also grow their debt proportionally, so that they always have the fixed capital structure in terms of the proportion of mix between debt and equity. Why does that matter? Because from the perspective of an equity holder, the capital structure measures the riskiness of the cash flow that the firm is going to repay the equity holder. Because equity is paid after debt. If there's too much debt in the company's capital structure, for the equity holder, they have a higher level of risk because the probability of not being able to pay any shareholders remains higher. They have to pay the debt holder first. And then if risk changes, our discount rate is going to change. But we don't want that. We want to be able to use the same discount rate and the same growth rate. So we also assume that the firm maintains fixed capital structure. Thirdly, we assume that the firm earns constant ROE. The profitability of their investment stays constant. What kind of company have constant ROE? Well, very mature firms. Mature business model, very competitive market. Basically, nothing is changing for the firm. The firm is reached its adulthood like a person in their mid-30s, well, myself, nothing's changing much. Well, but maybe person is not the good analogy because person can still change at any age. But for a very mature business, things are not very likely to change in terms of the cash flow they can pay their investors. Put things into number. Aqua America has a book value per share of $11.10 at the start of the year 2018. Suppose it will generate a return on this book value of 12.5% ROE, which is the ROE. Over the next several years, the firm is expected to maintain the same payout ratio of 62%. What is the firm's sustainable growth rate in equity, which can be achieved by reinvesting? Okay, we know that the plotback ratio is 1 minus the payout ratio, 1 minus 0.62, and the ROE is 12.5%. So we multiply these two numbers together to get 4.75%. This is the sustainable growth rate we have estimated. Well, do you think the 4.75 could be reasonable? Well, at face value, it does look reasonable. It's okay. The nominal growth rate for the US GDP is about 5%. At least it's not overgrowing the US economy anytime soon. But what if, for some reason, maybe a really high ROE or a really high plotback ratio, the growth rate turned out to be 20%? Do we think it's reasonable to use as a growth rate? Well, it could be reasonable for a few years, especially for a young firm where there's still a growth firm. But it cannot be the sustainable growth rate. Why? First of all, if a company can sustainably grow at 20%, eventually it can take over the universe, because this is a much higher growth rate than any economy on Earth. Secondly, it's hard to find a discount rate higher than 20% that can fit into the model of the constant dividend discount model. So it's just not reasonable to be a sustainable growth rate. If your calculation in your future valuation yields a growth rate that is really high, think twice whether it does represent the company's growth when the company have a stabilized business model rather than in the initial years. Okay, suppose we are at the year 2017. Aqua America is expected to pay a dividend in 2018 of $0.68 per share, which is 62% of their 2018 net income of $1.38 per share. And this dividend is expected to grow at the steady rate of 4.75%, which we just calculated. And if the investor require a rate of return of 7%, then what should be the price of Aqua America's stock? Okay, now we have sustainable growth, we have discount rate, we have next year's dividend. We're ready to plug everything into the constant growth DDM. Okay, we have dividend 1, discount rate minus growth rate. $38.22 is the reasonable price for Aqua America at the year 2017. Okay, and other things equal, if Aqua America did not plow back any net income for reinvestment, but instead paid all out as dividend, which means the dividend during the year 2018 equals to their earnings per share, which is net income divided by shares outstanding, then what should be the price of Aqua America? We know that sustainable growth rate will be 0 if the plowback ratio is 0. If you reinvested nothing into the next year's corporate investment, if you retained no earnings that you have generated over the last year to reinvestment, then the sustainable growth rate will be 0, because the sustainable growth is only funded by internal capital, by retained earnings. Then we're having a non-growth, 0 growth dividend discount model here. And in this case, the dividend also equals the EPS. Okay, and then we have EPS from the previous slides divided by the same cost of capital to arrive at 19.82. You can see that this number is actually much lower than in the previous case when they retain some earning into reinvestment. It seems like the market do think reinvesting in the same company is a good idea. The market is not eager to get all the earnings as dividend. Why is the case? Well, it is because that the return they can earn, the ROE from the company, which is 12.5%, is higher than the required rate of return from the investor, which is 7%. The investor only requires 7% as a minimum return, but the company, by reinvesting their capital, can give them 12.5%. So the investor is willing for the company to reinvest the earnings rather than distribute them to the investors. Okay, as long as we see the ROE higher than the required rate of return, it makes sense to reinvest some cash into the firm for reinvestment, because in that way the company can get a higher return than the investor can. But on the other hand, if we see an ROE is lower than the rate of return, the company should best give the money back to the investors so that the investors can go elsewhere, invest, at least earn 7%. Okay, now if we take the difference between the stock price with reinvestment and the stock price without reinvestment, this is the stock price with any growth, and this is the stock price without any growth, we can see there's a difference of $18.40. And this is called the present value of future investment that Aqua America is expected to make. The market is awarding an additional value to the stock because they believe that if the company reinvested in themselves, given the high ROE, they can generate additional value than if they did not invest anything in their own stock. We call this portion the present value of growth opportunity. The difference between growth stock price and no growth stock price. And then another question. What if the company kept its payout ratio at 62%, but their return from new investment was only 7%, which is the same as cost of capital? Then what is the sustainable growth rate and the stock price? Sustainable growth rate G equals to plowback ratio, which is still 0.38, multiply ROE, which is 7% now. We get 2.62%. This is a growth rate if the ROE is 7%. And then if we use this number plug into the constant DDM, we have 19.82%, which is equal in the previous case when there's no reinvestment. In this case, whether they reinvest any earnings does not make a difference in stock price, because what they can generate for the investors and what the investors can generate for themselves are both 7%. There's no difference of whether the company invests on behalf of the investors or the investors invest for themselves because of the limited ROE. All right, then we already answered the question, what if Aqua America can only earn returns lower than the investors' required rate of return? And then we know that the price is going to be even lower and it doesn't make sense to retain any earnings. They should give all of the earnings to the investors, and the investors can go elsewhere, invest in an equally risky asset, earn 7% as their opportunity cost of capital. To summarize, plowing back earnings into new investment only increase stock value if the investment return is expected to be higher than the investor's required rate of return. All right, let's talk about what is a growth stock and what is an income stock. I'm sure most of you guys have heard of stocks which are classified as either growth stock or income stock. A growth stock is a stock where the present value of growth opportunity accounts for a significant fraction in the stock value. The investors buy growth stock mainly for capital gains, because growth stock typically does not give much dividends yet. They're typically young firm or firm with very great opportunities for reinvestment, so they can use all their funds, and they might have to raise additional capital because there's too much good opportunities to invest to generate high return and just not enough money. So they're not going to pay anything to the investor because they believe this company can generate the best return for the investor. For example, a really good case is Microsoft. It had its IPO back in 1986. But before the year 2003, they did not pay any dividend. But the investor was okay with it, because they know Microsoft is reinvesting all their earnings into their projects, which generates high return for them. That's why, even though they did not pay any dividend, their price keep rising. Okay, and we're going to talk about how do we price this case using the dividend discount model. We can still do it. It's a little bit more complicated. We're going to talk about it in case 3. And income stock, sometimes we call them cash cows. Basically means that they milk cash. They give you a portion of cash periodically, but there's not much growth prospects. When you buy the stock at a certain value, and you can expect to receive a steady stream of dividends, but you cannot expect a really high jump up in price when you're ready to sell the stock, because the capital gain is not the main return from an income stock. Okay, it all depends on what is one investor's investment preferences when they choose between income stock and growth stock. Now let's look at the case 3, the dividend discount model with non-constant growth. Many companies grow at rapid or irregular rates before settling down to constant growth rates, or the sustainable growth rate. To value such a company, we follow 3 steps. Basically, we divide and conquer. Step 1 will be setting the investment horizon year, as the future year after which you expect the company's growth to settle down to a stable rate, the sustainable growth rate, the year when the company matures. And then we calculate the present value of dividends from now to the horizon year. All the irregular dividend payments, we price them one by one. And then step 2 will be to forecast the stock price at the horizon year using the constant dividend growth model. Because we know that after the horizon year, everything is going to fall into a pattern. The firm is going to stabilize this into a constant growth rate. And then we can use the constant dividend growth model to evaluate the stock price at the horizon year. And then, of course, this is the horizon year value. We have to further discount it back to the present. Step 3 will be to sum the total present value of dividends plus the present value of the ending stock price. Basically, we can summarize everything into the pricing model we have here. All those dividends up to year H and the value of PH, which summarizes all the future dividends which hasn't been received by year H. And we discount it accordingly depending on which year the cash flow is happening. Let's look at one example. Given the following earnings and dividends and a 8.5 discount rate and a sustainable growth rate or a perpetual growth rate of 5%, which begins in year 6. And what is the value of stock? The growth begins in year 6, meaning that the year 6 dividend is growing by a factor of 1 plus 5% on top of year 5's dividend. So the year 5 is our horizon year, because the year after the horizon year is going to be the first year the company is following a constant growth. Okay, let's see. We have earnings for each of the first 5 years, and we have the dividend payout ratio at 60%, so we know that dividends is always 60% of the year during the earnings during that year. So step 1 will be to find out the present value of all the irregular dividends. We now know that the irregular dividends is from year 1 to year 5. So we discount them one by one by the discount factor. Okay, and then step 2, the stock value beyond the horizon year. The first dividend expected after the horizon year is dividend H plus 1. The horizon year is H, so the first dividend is after the horizon year is H plus 1. In our case, the horizon year is year 5, so H plus 1 is 6. The dividend in the 6th year equals to the dividend in the 5th year. Multiply a growth factor of 1 plus G. Okay, because the 6th year is the first year that growth is following the rate of G. We have 4.717 multiply 1 plus 5% equals to 4.38%. The stock value at the horizon year can be estimated by the constant dividend growth model, because after the horizon year, everything's falling into the constant growth. So if we were standing at year H, we're looking at dividend H plus 1. Remember that the constant dividend growth model always uses the next dividend. This is mathematically required. We have derived it when we're talking about the perpetuity, right? And we have R minus G, which equals to P5 here because H equals to 5. We have dividend of the 6th year divided by R minus G to find out what is the terminal stock price. Now that we have all the components to put into the final pricing model. Okay, now we know that P0, the stock value today, equals to the present value of all the cash flows, all the dividends received up to the horizon year and the horizon year stock price, discounted appropriately. Putting everything together and do the calculation using the calculator, we have 96.72 as the stock price. Right, this is the way we follow the calculation steps. Using the financial calculator, we can, using the cash flow function on the financial calculator, to find out what is the present value. So we press CF. Okay, first of all, clear everything. Second, clear TMV, second, clear work, and then clear. CF, CFO0, there's no cash flow at time 0. And press down button. CO1, the first cash flow at time 1, 2.85. Enter, down arrow. Frequency is 1, down arrow. CO2, 3.14. Enter, down arrow, down arrow. CO3, 3.45. Enter. Sorry. So let's get the second one, CF. We already have the first one down, second one down, all the way to the third one. Okay, third one, we re-enter the, if we make a mistake, we just re-enter the number, 3.45. Enter, down arrow, CF, the fourth cash flow, CO4, 3.79. Enter, down, and go down. The fifth cash flow will be the fifth dividend and PH5. We can do the calculation inside of this formula. 4.17 plus 125.14. Okay, and then we press enter after we get the sum we want. Go down and go down. Now we have finished entering all of the numbers. We are ready to press NPV. And when the I pop up, we enter the interest rate 8.5 and then enter. Okay, now we go to the NPV calculation, calculate, press compute, get the answer. Okay, this is one way to do the calculation using the financial calculator. And of course, you can use Excel as well. Now we know what is a dividend discount model and how we use it to give valuation to stocks. Now let's discuss what is the limitation of the dividend discount model. We already know the benefits of the model because it's simple and it's straightforward. We only need to forecast all the future dividends and the appropriate discount rate. The investment horizon doesn't matter because at the end of our horizon, all of the future dividend is summarized by the horizon price. So basically, all we depend on is what is the future forecast for dividends. But the limitation of the model also comes into the need to forecast all of the dividends. For firms who hasn't stabilized yet, we need to make a lot of assumptions about which year is going to stabilize. And it's just putting a lot of subjective assumptions will make our valuation very subjective. And another thing is that we have to forecast the dividend per share. And in case the firm does stock repurchases, it's gonna reduce the number of shares outstanding. It doesn't invalidate the model. We just have to make adjustment, and it's making pricing using the dividend discount model quite complicated. Well, what is stock repurchase? Stock repurchase is when the company go into the secondary market and buy their floating shares from the shareholders. In this way, they can also give money back to the shareholder. And typically they have to buy beyond the market price so that the shareholders are more willing to sell it to the company rather than another buyer from the market. Well, why will a company buy their own shares from the secondary market, especially at a higher price than the market price? Well, as one way of giving back to the shareholders rather than giving a dividends. We mentioned the problem with giving dividends as dividend racketing. If you promise to give dividends, and it's typically a very negative signal if you go back on your words and stop paying dividends. So firms are sometimes really reluctant at starting a dividend paying policy because they know they cannot go back. But when they have extra money to give back to the investor, when they don't want to retain all their earnings, they can just use the earnings to buy shares back from the investors. This is also a way of paying back the investors, but you don't have to make a promise because stock purchases can be made like case-in-case basis. They don't have to commit to a stock repurchase schedule, although some companies do, but it's not the market norm. Okay? But once you repurchase the stock is no longer considered public floating or outstanding. And then you have to calculate what is the actual dividend per share. It's just a little bit more complicated, and it's beyond the scope of this course. Well, given the limitation of the dividend discount model, there is another way around pricing, which also uses the discounting philosophy. But rather than focusing on the cash flow that the equity holder is going to receive from the firm, discounted by the opportunity cost of equity investor, there's another approach. See the company as a whole pie for both equity holder and debt holder. And they price the whole company first, and then they carve out the portion for debt. The remaining ones will be the portion for equity, and then they can just divide by the shares outstanding to arrive at the price. This approach is called the discounted cash flow model. It's the same logic as the dividend discount model. Rather than it's taking the perspective of the investor as a whole, not only the equity investor. The value of an entire business can be computed as the discounted value of free cash flows going out to a valuation horizon, plus forecasted value of the business at the horizon, discounted back to the present. We introduced free cash flow in Chapter 3. It measures the amount of cash that the firm can pay out to all investors, debt and equity, after paying for all investment necessary for growth. Okay, it's very similar to the dividend to equity holder, but the free cash flow belongs to both equity holder and debt holder, because interest is also in the free cash flow. And if we discount free cash flow back to the present, the discount rate we use here is no longer the required rate of return of equity holder or the equity cost of capital. It will be the average between cost of debt and cost of equity. We call it the WACC, the weighted average cost of capital, which is also not in this course, but I'm sure you're gonna talk about WACC when you're going to a more advanced corporate finance class. So once we discount all the free cash flows up to a horizon year and summarize all the subsequent free cash flows by the horizon year's present value, we can use the same logic to price them back to the present to find out what is the present value of the whole business. Okay, and then we're not faced with the limitation of whether the company pay any dividend or whether they do any repurchases, because we're seeing the company as a whole. And after we do that, we can find out the present value of the entire equity value as the subtraction between the present value of the whole business and the present value of the debt. The present value of the debt is typically estimated to be the same as the book value of debt, because the debt value changes very little. And then once we get PV of the whole equity, we can divide it by shares outstanding to arrive at price per share. This is another way of going around for pricing. Well, here we talk about two ways of pricing stocks. by discounted cash flow and discounted dividend discount model. It's all seeing the asset as a future bundle of cash flow discounted to the present. These two approach have their merits because they use a lot of information. You have to go into the firm's financial statements and make substantiated assumptions about their growth, about their dividend paying habits, and about their future reinvestment, about their cash flows. We use a lot of information. But sometimes, just because of the amount of information we use, and because the information is from the future, we need to make a lot of assumptions. This valuation results changes dramatically when we change the inputs. And that means your valuation can be vastly off from my valuation. But when we are trying to price a company, we need reference points. We need to know what the market thinks. So sometimes another really simple method, use limited amount of information, actually can be a preferred approach, or at least it gives a lot of reference point on top of the two valuation model we had. This is called stock valuation by comparables. Basically, it compares the stock with another stock, which is very similar to this stock we have in mind, to see how much the market is paying that stock already, using that as a reference point. It's very similar to when we are looking at house. The housing market is still in a semi-bubble and is still very hot given the persistent low interest rate. When you're looking at houses and you like one house in the neighborhood, but you want to know what is the price you're paying for this house, whether it's reasonable. You want to run the comps, meaning that you look at the similar houses in the neighborhood and to see houses with the same years, about the same years built, with the same approximately the same size and the same features. And you want to see what is the price per square foot for that house. And then you use this information, you take the average from all of your comps, or just a few comps that is very similar to your house, and you multiply this price per square foot with the number of square foot from the house you have in mind to arrive at a price reference point. That is very often do in the real estate market, because that's actually the first step when buyers and sellers negotiate price. This is very similar to stock valuation by comparable. But for stocks, we have multiple comparables. While for house, the price per square foot is the number one used comparable. The comparables we use for stock valuation, the most often used ones is, of course, price to earnings ratio. How much the market is willing to pay for the stock per dollar of earnings. Okay, earnings is what their book value have, and price is market value. It's similar to market to book value, but in the market to book value, we also have the market to book value, we have the whole thing rather than price to earnings ratio is the per share basis. So we can see that here we have a number of company. We have the company's ratio. For example, we have FedEx market to book ratio. And we also calculated the average of all the companies' ratio from the same industry. And we use that as a comp. Okay, and then we can go around and price the stock using comparables. For example, suppose we want to value an international courier business, the same industry as FedEx, since it is a private company. If the company we have in mind is a private company, meaning that it does not have much financial information we can dig into, and then we cannot forecast its future cash flow, it's not feasible for us to do the DDM or the DCF. We only know that its book value per share is at $20, and the last year's earnings per share was $2 per share. How do we give a rough estimate of the fair price of one share of the company's equity? We know that it's from the same industry as FedEx. So we go to FedEx industry and we find out what is the average market to book ratio in the same industry. Sometimes we use the average and sometimes we use the median. And we find out that is 2.2 from the previous table. So we know that for the typical company in this industry, the market is willing to pay $2.2 per dollar of book value. So we use this comps to multiply the book value per share with the firm. And we cancel out the denominator, we get $44, which is the comp price that we give to the company that we have in mind. Besides market to book ratio, we can also use PE ratio. From the previous table, we know that the average PE ratio in FedEx industry is 20.7. And the EPS of the new company is $2. We use price to earnings multiplied by earnings, we get the price estimate. And here we are making the assumption that this new company we are trying to value is a typical company in the international courier business. Okay, and then we can use the industry average comp to do the pricing. And of course, we end up with a range depending on which comparable we use. Of course, comparable valuation have a lot of limitation, but we still use it all the time because it's simple and it actually summarizes the market opinion very well. Okay, and we can use all kinds of comps as we want. We can use market-to-book ratio, and this asking the question of how much investors are prepared to pay for similar companies per dollar of book equity. It's always the same logic for using comps. And for companies who doesn't have much earnings or don't have much asset on the book, we can just be creative in using the comps. For example, a YouTube channel price its monetization to the number of likes, and there's all kinds of algorithm for that. And you can also have, well, the comps that you like. It's a quick valuation reference. Because of the limited amount of information we put into there, it's a rough estimate, but it can be an invaluable source when you're doing your pricing practice, because, well, sometimes the more information we have, if the information is not substantiated, if it's based on assumption, it might be better if we don't use that much information. Okay, the bottom line of valuation is to use all the information you have and came up with a range. Vary your assumptions and came up with a range, and then find out that what is your range of pricing, and think about what happens on the two spectrum of the pricing. Okay, this is actually what the investment bank do in their roadshows. They ask the opinion of potential buyers when they're helping one company to go public, and they came up with a price range of the reasonable price when the company goes to public. Okay, and I've put one practice from Excel in the supplemental folder for spring break, which shows you how to do a sensitivity table from Excel. I think that little tool is very useful when you are doing valuation, because you can easily vary by a two-dimensional table of two of your important inputs to see how that makes a difference in your valuation, the range of valuation results. Okay, make sure you check it out, but it's not required for this course. Anyways, anything Excel, also very useful, is not within the scope of this course because of the limited time that we have together. But I highly recommend you learn as much as you can about Excel and how to use it in personal finance and in your work. Okay, that is all for the first week of stock valuation. Next week, we're gonna continue the discussion. That's it for now. See you soon.